You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. We are taping Options Playbook Radio. It's Wednesday, October 6th. The markets are open and they are rocking and rolling. We've had a very volatile week. We got the VIX up above the 20 handle, which seems to be the line in the sand, if you will, between high volatility and low volatility. At least the marketplace seems to think that way. So with the VIX being up above the 20 handle, we have a lot of news as usual that can be driving some of this volatility. But overall, we really have had some wild swings for the first time in 2021 in the marketplace that is also obviously driving some of the volatility overall. So with that said, let's talk about what happened in the VIX last week. Our paper trade for the week was an actual short spread. We sold an in-the-money short call spread. We talked a little bit about why we did that on the show last week. So if you want to understand why we sold an in-the-money, which is usually done out of the money call spread overall, you can do that by going back and listen to the archives. But we did a 2-point wide spread. We sold the October 13th expiration 21 strike call, and we bought that same expiration 23 strike call. The VIX at that point in time was around 22.5. Futures were trading fairly close to that 23 level also for that expiration date. And we were able to get it done for 73 cents net credit to the account. Now, on the show, our goal was, we don't pick when we tape Options Playbook Radio, right? We just tape when we can. And ideally, I would like to do that trade. And I'd like to make it a 50-50 trade in that I bring in a net credit of $1. My max risk is $2, the width of the spread, meaning that I'm risking $1 to try to make $1 on that trade. When we did the trade, it was 73 cents. VIX has not came off. We got a week till that expiration date. And we did this it was a little bit intentional on my part to go a little bit further out so that we could have something to talk about here on Options Playbook Radio with the VIX. I've been getting a lot of questions. Our clients have been asking a lot of questions about it because when people see high volatility, they want to run to the VIX product because almost everybody knows that high volatility eventually has to go away. But trying to get when eventually is the key situation here. So with the VIX at that level, I want to point out that right now we have the VIX trading at 2194. And I'm just going to pull up a quote on it. We're just going to leave it at that. And that if we pull up a quote, we see that this same spread that we talked about as a paper trade last week is trading basically at the same price as it was last week. Now, my moral to the story is eventually the VIX option contracts, which track the futures contracts that expires on that expiration date, will morph into the actual VIX index. Now, this is a futures concept, but the VIX is considered the spot. And at expiration of the futures contracts, it basically has to become the VIX index. Okay. So with that said, a lot of people like, oh, I think volatility is going to come down. I'm going to do a VIX trade. Well, if you're doing a VIX trade, you really want it to come down the week before, because that last week you have a lot of risk as to where this thing is going to land. And in one day, the VIX could spike up 20, 30, 40 ball points just because of the open on the marketplace. So if that happens to be your expiration date, that is a bad thing if you are short a call spread. So the moral to my story right now would be, if I'm in this trade and I'm trading, it's basically trading where I put the trade on, I might want to think about taking it off. Or at least if I did 5 contracts, take off a couple of them, because in the last week, it's going to get crazy. Now, remember that most VIX options will expire on Wednesdays just because of the way the actual VIX index is calculated overall. So it's more common that it will expire on a Wednesday. So if you are going to ride it out, I would think about maybe trading out of it on Friday or Monday. Right? Overall, you just that last 2 days of premium in the VIX option contracts a lot of times isn't worth the risk of that trade overall. So whenever I would put on a paper trade in the VIX or just a general trade overall, I always will have a buyback in to try to buy it back at 10 or 15 cents, because just removing the risk because of the underlying product at any point in time in the life of the contract, even with 1 minute to close on the market the day before the expiration date, it's usually worth it overall, because there's nothing like the VIX is the VIX, and it's a standalone product that there no other product on the marketplace acts like the VIX does overall. Okay. So interesting. It's trading right where it was at. VIX is, I guess the VIX is fairly close to where it was last week. 21.94 by markets open right now. 22.56 is where it was at. So we're trading fairly close to the same credit point too, even though we've had 1 week's worth of time decay overall. All right. So we answered some listener questions, and overall I've been receiving a lot of them, and a lot of them were with butterflies. And I do think if you're trying to catch falling knives overall in this marketplace, first of all, it's a dangerous thing to do. But one of the ways that I would approach it, and as always on Options Playbook Radio, nothing's meant to be a recommendation. We're just trying to look at market conditions and say, out of the 40 plays inside the optionsplaybook.com website or the actual book, that what trade might apply to the current market conditions. And if I'm looking at a volatile marketplace, I like to think about skip strike butterflies as an alternative to maybe selling a short call spread or a short put spread. A lot of people are tempted to do those trades because vol is up, and I want to try to sell some of that vol premium so I can go further out, further away from the underlying stock price and still get a decent amount of premium on that trade. So that's always enticing. So if you are a short spread trader on the call side or on the put side, an alternative, like a lot of people don't think about this, they think about a skip strike butterfly as an alternative to a butterfly. But I like to pose it as an alternative to an actual short spread. So I'm just going to look, the QQQs have been beaten up. I have no idea if they're coming back or whatever. We're still in October. September proved to be volatile. Everybody talks about the volatility in September, and guess what? It was volatile once again on the calendar. And the next most volatile month usually is October, and so we're in that October, in that volatile period overall. So If I was thinking about trying to bottom fish on, you can pick your underlying. I'm going to use the QQQ, which is the ETF that tracks the NASDAQ stocks overall. I would think about looking at a skip strike butterfly to target the upside. Now, I can sell a short spread and then maybe adjust it. One of the things about a skip strike butterfly is if I put it on, I'm just going to let it ride. And I prefer to do them in indexes because you don't get as big a gap openings. They're a little bit easier to manage. A 2% gap opening in an index like the QQQ, which is the ETF that tracks an index, or the SPY or SPX, is a real big move. It does happen, but it just doesn't happen as often as you would see in an underlying stock. So if I look at this trade, here's what we got going on. We're going to go out to November. Once again, we're just going to try to avoid October. So we're going to put this trade on and give it some time on this trade. So I prefer to stay a little bit closer to the expiration date. But if we go to that November 1st expiration, as I said, we're taping the show. It is the 5th. So we have a few days before this trade to play out. So we're going to go a little bit further out of the money on this trade. And what we're going to look to do is determine what is the long straddle, what is the expected move with that November expiration. So when I look at the expected move on the QQQ, right now the most at-the-money option contract with the QQQ trading around, we'll call it 358. As I said, the market's moving. The midpoint on the long straddle, if we bought the put and bought the call with the 358 strike, is $16.83. We'll call it $17. So quite simple. I'm bottom fishing. That's the expected move. They're saying that move is feasible. That's the over-under, if you will, on the market based off of what the options are pricing in. So I want to go over. I want to say, well, I'm looking for a pullback, but I don't want it to come too quickly to me. So this is how I would set up a skip strike if I was trying to bottom fish on an index like the QQQ, or you could apply it to your Apple was down a little bit today, whatever underlying you want to do. Feel free to take this concept and apply it into your own portfolio. Okay, so in that instance, that means if we add 17 points, we're looking at about 375 or so. So we're going to buy the 375 strike call. That's going to be the first call in our skip strike butterfly. Now, I would like to go as wide as I can and still try to get this done for a net credit, because that's my whole goal of the skip strike butterfly, is that you're really actually selling an out-of-the-money call spread to help pay for your butterfly. That's really what it is, and that's what happens when we skip that strike. Some people call it a modified butterfly. I don't like that because it doesn't explain what you're doing. It's not as clear-cut overall. But if I go and I do this trade, I would be going 3 points wide on the butterfly. So I'm going to go 375 strike call on that November 1st expiration, selling 2 of the 378 strike calls. And then we normally buy the 381, but we're going to skip that. And we're going to go another 3 points out and buy the 385 strike call. Now, I can get this done at a net credit to the account of 4 cents based off of a midpoint fill. There's no guarantee of midpoint fills. I always got to emphasize that. And obviously, we still got to pay commissions. So you got to account for those commissions. So this is just literally a lottery ticket that you're looking at here. You're hoping the market comes back. You're going to hope that it goes through. I'm not going to tie up a lot of capital. I do have 3 points of risk. If it comes roaring back and it blows through my short strike, in this scenario, the 378 strike call is my short strike. Well, then I have some risk on this trade overall. Or if it just moves too fast against me, I could have a little bit of risk on this trade. But the maximum risk is 3 points or $300 at the expiration of these option contracts. So I do have a little bit of a margin requirement. I'm going to have to put up that risk capital to put this trade on overall. And at some brokerage firms, they might make you take the whole $6 out. Every once in a while, you'll see brokerage firms that will do that, which is the actual short spread overall. They won't give credit to the butterfly in general. I just want to keep that in mind. That's just a FYI. But if I'm putting this trade on, my risk is going to be $3. So I put it on for a net credit of 4 cents. I watch it periodically. I set alerts on the QQQ. If we are up 5 points, I want to know. We're up 10 points, I want to know. We get up 15 points. Now the trade gets interesting overall. And we would just like it to land somewhere within a 6-point range. Now, as we get closer to expiration, you want to be correct closer to the expiration on your butterflies than not. And here's the main reason why. Is you want that market to come towards that 378 strike. That's a sold option contract. You need time decay. You need to close out that position. And at the money options have the most time premium. So in order to close it out at the lowest priced overall, you need some time decay or you need some decrease in implied volatility to try to help you out with this trade. So if I'm doing this trade, I'm not looking for a home run. If I can get 50 cents, if I can get $1 on this trade, I'm not risking a ton, but that's the way that I'm going to approach it. Much the same way that I would approach a short call spread, right? If I'm doing a 2-point wide short call spread and I'm out of the money, it's very common that I would do that for a quarter or maybe 50 cents overall. So treat this trade as an alternative to a short call spread as opposed to an alternative to a butterfly. That would be the moral to the story. All right, and that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. You want to know more about what we're doing over at Ally, please follow me on Twitter. My handle's @BrianOverby. We have a big event coming up in November, a huge digital conference. It's going to be on November 3rd, all day long via the Ally Invest YouTube channel. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.